It's Thursday, February 7th. Welcome to Market Foolery. I'm Chris Hill. Joining me in studio today from Motley Fool Pro and Motley Fool Options, Jeff Fischer and Nick Crow. Thanks for being here, guys.
Thank you, Chris.
And historic appearance by Nick Crow. For longtime listeners, I'm just going to give just a little bit of background for our dozens of listeners. Nick Crow, part of the Pro and Options team with Jeff Fischer, who we've had on the show before, and Brian Hinman, who we've had on the show before. Jim Gillies, who has come down from Canada.
Many times.
We've relaxed our border patrol to let Jim Gillies into the country. And it took basically a year and a half of browbeating to convince Nick to come in here.
You made me promise over the holidays, like as your Christmas present, to come in.
Come in once a quarter. So we're going to wrap up the week with a round of Undervalued, Overvalued. And we haven't done this in a while, but for newer listeners, this is when the guys just come to the table with stocks that they think are undervalued or overvalued. Let's start with the undervalued. Jeff Fischer, what do you got?
Okay, so there is going to be a time in our lifetimes, and maybe very soon, where we use our voice to do almost everything. Turn on the coffee pot, turn on the oven.
I love it already.
TV. Yeah, exactly. And our hands and arms are going to wither up, and we may come to resemble fish or seals eventually, because all of our technology will be driven by voice. So my undervalued potentially is Nuance Communications. The ticker is NUAN.
Okay.
And for avid Fool lovers who are members of Rule Breakers or Supernova, it is a selection in those two services.
This is the company behind Siri, isn't it?
It supposedly, yes. No one will admit to that, but for privacy reasons. But yes, it is widely believed they drive Siri, which is a plus and a minus, depending on how you look at it.
I don't have Siri on my phone.
Siri frustrates me to no end.
Does she?
She doesn't listen very well. But
are you talking about fish and small arms?
But they're working on it. They are working on it. Nuance Communications provides voice dictation, text to anything to turn your voice into a command or a message, or increasingly drive your car. Well, not drive it, but control various things in your car. And they're growing rapidly, double digits, and I think trading at 11 times estimated earnings for the year ahead. So shares are down quite a bit recently, and I think there may be an opportunity here.
If this universe is going to expand this much, and I believe you when you say that
our arms will
no, not so much on the arms will wither and will resemble fish, but the whole notion that many more things will become voice command. I buy into that. That being the case, they can't be the only company competing in this space. Who is their number one competitor? Who keeps Nuance up at night?
You know, it's evolving so rapidly, but I would say Google would be one of their largest risks. And the carriers, AT&T and Sprint, and if they were to get together and try to put an offering in this space, that could have some staying power. But I doubt that'll actually happen. So it'd be Google, someone well capitalized like Google. But right now, what draws me to Nuance is there is no clear competitor, and they operate in 4 divisions. They are consumer and mobile, and they have customers, everyone from Mercedes-Benz to Garmin to Audi to I think Bose or other electronics manufacturers, Sony. All these kind of brand names are using them, and they're now selling their products on a license basis too, and per use. So not just selling the software, but every time you use it, you'll pay. And they also have a very large business in the medical and healthcare industry, where doctors use it to dictate what they're saying and keep a record of it with their patients as well.
Okay, as long as that's all they're doing, because if it's just using voice command to turn on my coffee pot, that's fine. But if the doctor is using voice commands to operate instruments, that's going to make me nervous.
I don't know, Chris. You've got a great voice. You might have a competitive advantage in using this technology in the future. So
they're a leader in
Nick Crow sucking up to the host. It's always a good strategy.
It's his first. He should on his debut. And we all love it or hate it. Sometimes it works really well lately. They are a leader in enterprise solutions where when you call and you get everything done through a voice instead of a person.
Nick Crow, what do you got for an undervalued stock?
Undervalued to me was an easy decision. AIG. The company people love to hate, and why not after a $182 billion bailout from U.S. taxpayers. It saved the financial system, and their sins maybe not been forgiven, but they're asking for forgiveness. and saying thank you on lots of different ad campaigns, which have been more or less poorly received, but that doesn't really matter because this company's so cheap, and that's what you asked for, most undervalued stock. It's trading at probably 0.6 times their tangible book value, which book value share comes in about $69, and they're trading at $39 right now.
Wow.
So for us, what that means for an investor is if they return to, say, even a 10% return on equity, they could be earning we 20% annualized returns on this thing if they can maintain that level of ROE once getting their underwriting in line. And I think they are getting their underwriting.
We had talked about it recently that AIG had just sold some division, and I forget what the division was, but it was something that really was not sort of in the wheelhouse of finance and banking and that sort of thing. Is that part of your calculation as well? Not just that, wow, when I look at the balance sheet, it really seems like an undervalued stock, but also from a management standpoint, it seems like, wow, they're really trying to be more effective in the way that they deploy capital.
Well, absolutely. So I really like Ben Maché. That's the new CEO. Well, he's been a CEO there for a while, but new as in post-crisis.
Okay.
And the company you said that they're getting rid of was ILFC. The aircraft leasing.
Yeah.
That actually hurt book value when they by getting rid of it because they're selling it for less and it was carried on the books. So that'll ding book value a little bit, but doesn't matter. Company's still really cheap. They'll be deploying that capital maybe back into the company or paying off debt. There'll be a good return for shareholders on that. But to your point, they are focusing on their core businesses, property casualty insurance, Sun America's life insurance and retirement type services. So very, very, very focused now. They've been buying back a ton of shares, $13 billion in 3 quarters last year, and all of that raises book value per share because they buy them back at less than book value.
Yeah, Chris, it's funny. Joe Mager loves AIG or recommends it as well.
Yep.
We own it in Pro.
And the calls.
I own it myself. It feels a little odd to be saying this on a podcast to our listeners that here's a company that was the kind of the shame of the nation a few years ago, and now we're all saying buy it. But that is contrarian investing at its best. For all the reasons Nick just mentioned, they've turned the ship around, and it's still super cheap because it's so tainted.
Where I don't know Ben Maché's history at all. Where did he come over to AIG from? Do you know?
I believe they grabbed him out of retirement, but he was at MetLife before, CEO there, and very well respected. The guy he's brash and he's honest, and he's the perfect guy to right the ship, and really to just clean it out.
Great. Let's move over to the overvalued stocks. Jeff Fischer, what do you got?
Well, this is another company we've owned in Pro, but we sold it recently. It's Bristow Group.
Okay.
The ticker is BRS. They lease helicopters. They own helicopters and lease them to deep sea oil drillers. So they fly staff of ExxonMobil out to these rigs and back again.
And supplies too, I think.
And supplies too, sure. And donuts and coffee.
I love them already.
On a daily basis. So it's a good business with a lot of recurring revenue because their contracts are long-term and they get paid even when they don't fly. So they don't mind a hurricane, say. They're still making some money sitting on the ground and their expenses are lower. But it's not a high returns business. Their return on equity is running around 6%. So what we did in Pro was bought it when it was below book value and sold it when it got reasonably above book value. And it's kept going up. It's now around $58, $59 a share. Book value is around $43. So we'll watch it and look to buy it back in the low 40s when that happens because, again, it's a low return on equity, low returns business, period, return on capital, everything. So it's not the sort of thing you want to own as it soars higher. But I thought I'd mention it and use it as an example because I think it's a really good type of business that listeners could learn about and watch and buy right around book value like we do and then sell when it goes up above book value.
Well, and this also sounds like a situation, and please correct me if I'm wrong, but it sounds like this is one of those situations where your thesis played out when you bought it, meaning that you bought this fully intending to keep watch over it, thinking, oh, this is not necessarily a stock that we think is going to change the world and is going to grow forever. This is a stock that we think we can get a return of X, and when we get that, if it gets to that point in shorter order than we expect, then we're going to sell it.
Exactly, Chris. And we tried to make lemonade out of lemons a couple of years ago. We bought it soon after the disaster in the Gulf.
Sure.
And because everything was beaten down, and this thing was trading below book value. And yeah, that's exactly why we bought it.
Nick, what do you got for an overvalued stock out there?
This one's not going to be popular to your listeners. However, I will say that I own it and still own it, and I'm still going to tell you that it's overvalued, and that's Netflix.
It's had quite a run lately.
Huge run. I mean, $81 a share gain this month alone. Well, I guess year to date as we record this. So that's a huge gain, and honestly, a little bit too quickly given the competition you see. So one thing that, investors are very excited, they turned a profit when they were expected to turn in a small loss, but they turned in a very, very small profit. They're investing heavily in their business, investing in new content, and that's really where, the content wars are going on. But what we are seeing is they have exclusive content now. They've developed their own House of Cards. And
yeah, it's getting great reviews.
Have you seen it?
I have not seen it. I don't have Netflix, but honestly, this is the first time I've thought to myself, well, I might need to get Netflix for a couple of months just so I can just mass consume this show.
Yeah, I'll send you an email with a free invite.
Nice.
So House of Cards, I'll probably watch it tonight, actually. I heard it was really good also. So it'll be great. But then you see Amazon, they've announced that, I've not seen this show, but it's very popular, Downton Abbey.
Downton Abbey, yeah.
And so they're going to have an exclusive contract for the season 3 and beyond on that. So what you're seeing is just huge investments by very well-heeled businesses, people with much larger cash balances and purchasing power than Netflix. So it's a very difficult business to be in right now, and I think they're doing a phenomenal job. However, any misstep, the smallest misstep, and they'll be punished heavily by the market. And that's why I think that they're probably overvalued right now, because they're priced for perfection. They might do it, but it's the upside-downside ratio, if you will, I think is out of whack at this point. And earlier investors this year, like myself and many of I know Fool subscribers, were smart to buy when everyone was against it. Now that everyone's cheering Netflix and it's going up 5% every day, I don't know, makes me very nervous.
I just wonder when they'll have free cash flow and earnings again in a sizable amount that merits a sort of valuation and the sort of headlines the company gets all the time. It's not near. It has a wide customer base, but it has tiny net income.
Right.
And given the way costs keep going up, and they are almost a victim of their own success. The more customers they have, the more content providers are going to demand for movies. So I find that fascinating, but I don't have that much room to speak because I've been right and wrong on Netflix so many times that I don't know where I stand.
Earlier this year, you wanted to short it, and thank God we didn't.
I was bearish at 300, but then I was still bearish at 57. I thumbed it down in caps.
Okay.
I flipped up, thumbs up at 80. So I'm right there. But I don't know. That's where I come down, really. It's a fascinating thing. I owned it long ago. I haven't for a while, but.
You're like a guy at a racetrack, just like I picked winners in the first and the third. I lost in the second and the fourth.
And it's funny because I'm so opposite that. For the most part, I own companies and I just own them for a long, long time. And there are certain companies where I can't get comfortable with, and that's what it is.
To Jeff's credit, he didn't put any capital behind any of those. That was just, banter across the desk, a little bit on caps. I mean,
exactly.
So
trying to figure it out.
And when you don't know, that's what you do. Don't put your money there.
Before we wrap up, since we are talking Netflix, I'm always looking for movie recommendations, whether it's in the theater or just something that you've watched online, on Netflix, on cable. What do you got for me, Nick?
I've got two things for you, Chris.
Okay.
One, my favorite content that I saw on Netflix was The Wire. I think it's it's kind of a crime drama, super gritty. Baltimore is kind of the scene there, and makes you more nervous when driving through Baltimore.
Yes.
And then I watched, this was a Fool thing, kind of people at the Fool got together to watch this, and I wasn't able to join them, so I watched it last night, and it was Jiro Dreaming of Sushi.
A documentary about
about
a sushi master, or I'm probably not getting the term right, but basically a guy who's dedicated his life to the art of making sushi.
Absolutely. And then so we have an analyst development program here, and one of the tenets that's been taught there is this idea of continual improvement, of mastery, of deliberate practice, and this guy put deliberate practice to practice in sushi, and he has the best sushi in the world, and he's a little bit insane about it, quite honestly, and that's what makes it fun.
Sounds like a compelling film. Jeff, what do you got for me?
I'm going to bring us down a few notches and go old school and say Tommy Boy.
Tom, we were talking about this before we started taping.
Were you?
Tommy Boy is also in that category of films that I just enjoy, and if I'm channel flipping, channel surfing, and I come across it, boom, I'm there.
Yeah,
I believe the category he said was brainless.
Yeah, on Amazon Prime.
I don't have to do a lot of thinking with Tommy Boy, but it is a comedy that holds up. I will put it that way.
I hadn't seen it for years. I clicked into Prime, Amazon Prime, and it was right there, and I had no choice but to watch it.
And one of the coffee mugs I have on my desk is actually Callahan Auto Parts.
Nice. It's classic. My wife did not like it though. She doesn't get the humor.
You know,
so.
it is one of those movies that
Yep, it's kind of a.
I think it's fair to make the broad sweeping statement that guys may enjoy that on balance more than their wives.
You said it.
I said it. Send your angry emails to me, radio@fool.com. Before we wrap up, Motley Fool Pro, the service, one of the services you guys work on, has reopened for a limited time, and I want to give you a chance just to make sort of like a 20-second pitch about sort of
Okay, Chris.
what Pro is all about.
Pro reopens on the 14th on Valentine's Day.
Yep.
Thank you. And we are about making money in up, down, and sideways markets. We have a core portfolio that we hold for the long term. We use shorts and hedges to balance out volatility, and we use options to make steady income. So our goal is really to make annualized returns that are steady, recurring, and strong with less volatility. And it's a great, foolish, long-term and short-term approach.
We have set up a free microsite. The address is just proacademy.fool.com. That's proacademy, all one word, .fool.com.
Yep, give it a look because we only open once or twice a year.
Yeah, the site is up right now. I actually watched. There's a about a 2-minute video from Tom Gardner, our CEO, talking about Motley Fool Pro and investing in general, and there's more sort of
and then
beyond that.
We have to suffer viewers through. I have to. I'm sorry, not Tom. 3 more videos after that. They're each 8 minutes, and I provide 1 or 2 investment ideas in each one. Live, real trades you could make.
All right, check it out, proacademy.fool.com. Nick Crow, Jeff Fischer. Guys, thanks for being here.
Thank you.
Thank you, Chris.
As always, people on the program may have interest in the stocks they talk about, and the Motley Fool may have formal recommendations for or against, so don't buy or sell stocks based solely on what you hear. That's it for this edition of Market Foolery. Our producer is Matt Greer. I'm Chris Hill. Thanks for listening. We'll see you on Monday.